Let's see if it goes down to bounce on that 50 to 1. If it does and it comes back up, then it's more likely to go above the 100 to 1. And then what you do is you just let them reset the currency. And just like you would pay off your mortgage, because you see, spot gold is something like 4,600 an ounce. But what's the face value on this coin? $20, right? As we go into this reset circumstance, I can tell you today it's worth about 40,000. So what I would do, right, if you're looking at the strategy, if you have 20,000 in student loan debt, and we know that the fundamental value of an ounce of gold is 40,000, then what you need is a half an ounce of gold to cover that.
In this video, market strategist Lynette Zang breaks down a powerful gold-to-debt strategy tied to an upcoming currency reset. She explains how watching key ratios, such as the 50 to 1 and 100 to 1 levels, can signal major moves ahead for gold. If prices bounce at these levels and continue higher, it could confirm that gold is being revalued far beyond today's spot price. While spot gold may trade around $4,600 per ounce, the discussion highlights the massive difference between market price and true fundamental value. Using historical context, the face value of gold coins is contrasted with what gold could be worth during a monetary reset, potentially $40,000 per ounce. This shift could dramatically change how debt is viewed and managed. The video also explores a practical strategy, using physical gold as a hedge against student loan debt and other liabilities. If gold is revalued to its fundamental level, even a fraction of an ounce could theoretically offset tens of thousands of dollars in debt, offering a radically different perspective on wealth preservation during systemic change. If you found this helpful, like, share, and subscribe to the Metal Bar, turn on the bell so you don't miss any updates, and comment below to share your thoughts on it. Appreciate you for tuning in. Now listen to the interview.
This takes you all the way back to 1693. So, you hear a lot about the 15 to 1 ratio. Well, that was from 1693 up until shortly before 1913, when we had a little bit of shift, but that was the norm. And you can see it stayed very steady for 15 ounces of silver to 1 ounce of gold. But then there was a pattern shift. That's why I always talk about the pattern shifts, because you don't need to really understand exactly why something is shifting. When it shifts, it gives you a heads up. And we could see that pattern shift that happened right before 1913. And there you go. Then we're off to the races, because that's when it shifted to that 20th of an ounce of gold, this itty bitty piece, to 1 ounce of silver. And when I'm doing the fundamental value, I do it from 1913, that 20th to 1. What it's going to be, I don't know. But let's look at this more closely, because you can look on this chart and you can see when it hits a bottom and also when it hits a top. So 1940, that ratio was 100 to 1. And then, of course, it drops back down to 17 to 1 and then back up. Right? And testing it, 91 to 1, etc., and on. And we're going to look at this more closely just so you can see these patterns and as they've shifted. And so by, 2020? And really, if you look at the dates on this, what was happening? These were big, major crises. In the 40s, we had the war that was really erupting in Europe, and the U.S. became, in a little bit later in the 40s, the world reserve currency. In 1991, that hit a 91 to 1 ratio on it. What was happening in the 90s? There was a major transition that was happening, and we see it in the banking sector. I could take each one of these dates and draw a string of what was happening in the financial system at those periods of time. But there's typically a crisis, and in a crisis, we see more of a shift toward gold as the primary currency metal. And when we're looking at where we are today, or at least when I pulled this on Friday, we were at a 58-to-1 ratio. So it's dropped very substantially because there are times when spot silver is moving faster than spot gold and vice versa. So we're going to look a little bit more deeply. So we get rid of the 15-to-1 piece, and now you can see this a bit more clearly. Ultimately, we see it in the spot markets, which again are not about supply and demand, true supply and demand in the physical. They're about contracts, and they can create as much gold and silver as they want. And so they're losing control of that digital market. And that's what you look for. So we're already seeing it. An impending revaluation will come after the public loses confidence and we go into that hyperinflationary period, because they will do the revaluation. First, they're going to just print a ton of this, because that's the only tool they have, is just to further take whatever little bit of viability and purchasing power out of the currency. But since the public then recognizes the loss of valuation, it happens like really, really rapidly. In order to regain it, once it gets to a certain ridiculous level, that's when they do that overnight revaluation. So we are not quite there yet, though I've been saying for a while that technically I believe we are in the very early stages of the hyperinflation, and I maintain that position. I definitely maintain that position. And I definitely pay attention to that confidence level, because once it breaks below that lower level on support, I don't know what that support level is. It's never gone there before. So we're going to have to find out. But for me, that's when the clock will start ticking to when that hyperinflation will become visible to the public. I don't think it'll take too terribly long after that before we see that inflation go up again. And what are we hearing? You know, I really do have to hand it to President Trump that once he realized that affordability mattered again, he did shift his focus to try and get some prices under control, try and create caps on how much interest credit card companies can charge at 10%. I mean, he can't just do that.
This interview dives deep into the historical gold to silver ratio and why long-term pattern shifts matter more than headlines. The discussion begins by tracing the famous 15-to-1 ratio all the way back to 1693, where it remained remarkably stable until just before 1913. That stability ended with a major pattern shift, an early warning signal that preceded massive changes in the global financial system. From 1913 onward, the ratio moved toward 20-to-1 and later experienced extreme swings, including spikes to 100-to-1 during periods of major crisis, such as World War II, the early 1990s banking transitions, and again around 2020. Each of these moments coincided with systemic stress, currency instability, and a renewed shift toward gold as the primary monetary metal. The interview explains how spot markets today are driven by paper contracts rather than true physical supply and demand, allowing digital gold and silver to be created without limit. As confidence erodes, control over these paper markets weakens, setting the stage for an eventual revaluation. The conversation also explores hyperinflation, public confidence thresholds, and why currency revaluation tends to happen suddenly and overnight once credibility collapses. With the gold-silver ratio recently falling near 58-to-1, the patterns suggest another transition phase may already be underway. Let's get into the interview.
The spot markets, the government, the central banks losing control of the spot gold and silver market, and this transition away from the digital markets dictating price to the physical markets dictating price. That's more of a true supply and demand market. So that's what I'm paying attention to, as well as that confidence level. But that's what these surging prices are telling you, is that those that understand do not trust the money supply because they know what's going on with it. An early warning signal is the ultra rarities on the PCGS website, because a lot of those coins are in the many, many millions of dollars for a coin that looks like this. This is not one of them. And so as long as a smaller institution fails here and here and here, then you and I don't see that. And in 2008, and it was before I got print screen, and I haven't been able to find it since, but I read it. I saw it with my eyes, and I read it, where the FDIC said that if even one more small bank had failed, then everybody would know that the FDIC has no money. So quite honestly, they're going to have to do a bail-in, but they're going to try and avoid anything below the insured amount, because that's what would create the problem. So first they'll bail in the funds that are not insured. So whatever you have in there that's above that $250,000. I remember they raised that during the financial crisis from $100,000 to $250,000, so people would feel more comfortable and stay in the system. This is all about keeping you in this garbage. That's what this is all about, because then it's easier to transfer your wealth. So yeah, I'll bring that current, but the last time I checked, no, the emperor has no clothes. The FDIC has no money in their DIF account to pay for all the insured deposits, let alone the uninsured deposits. A little bit more than a penny, but I'll make that current.
As this discussion wraps up, the bigger picture becomes clear. The shift away from digital price control toward physical gold and silver is no longer theoretical. It's already unfolding. Rising prices are acting as a warning signal, reflecting a growing loss of confidence in the monetary system. Those paying close attention understand that when trust in the money supply breaks down, tangible assets begin to tell the real story. Behind the scenes, stress in the banking system remains carefully managed to avoid public panic. Small institutional failures are contained, while policies are designed to keep capital inside the system for as long as possible. Deposit insurance limits, bail-in structures, and confidence-based messaging all point to a system working hard to preserve appearances rather than address core vulnerabilities. Meanwhile, physical metals, rare assets, and real supply-demand dynamics are quietly asserting themselves. When market confidence finally slips below a critical threshold, events tend to accelerate rapidly, often overnight. History shows that once that line is crossed, policy responses come fast and decisively, leaving little time for preparation. That's why understanding these signals now matters. Whether you're watching gold, silver, or the broader financial system, staying informed is the first layer of protection. If you found this helpful, like, share, and subscribe to The Metal Bar. Turn on the bell so you don't miss any updates. And comment below to share your thoughts on it. Appreciate you for tuning in.